All right, let's talk about unemployment versus inflation, and more specifically, the Phillips Curve, which is central bank religion. And it basically just says that low unemployment leads to inflation and high unemployment leads to disinflation.
Totally.
Which in turn would suggest that the labor market must weaken to tackle inflation. But then it has no explanation for stagflation. So let's get into this and break it down all one by one. For those of you who were wise enough to skip taking econ at school, one of the most influential economic models central banks like to use to inform their policy is the Phillips Curve. And as I mentioned, it just suggests that inflation and unemployment are inversely correlated. So as unemployment goes down, inflation goes up, because if unemployment is low, meaning the labor market is tight,
that's what she said.
the economy is assumed to be running on all cylinders, with lots of economic activity putting upward pressure on prices. But if unemployment is high, the economy is assumed to be struggling. Go figure. Meaning people don't have the jobs they need to spend or drive demand, which would translate to disinflation or even outright deflation. So based on this understanding of the relationship between inflation and unemployment, central banks generally form policy under the assumption inflation can't be lowered with a strong labor market and can't remain elevated with high unemployment.
Totally.
And while this inverse relationship is usually true, and thus, I suppose, not a completely useless model for central banks to reference, it doesn't offer any explanation for stagflation. And stagflation is just when high unemployment and inflation coexist. So it entirely upends the Phillips Curve as a model, and yet central banks continue to use it.
You're a fucking idiot.
I bring this up because quite recently, central banks have looked to relatively strong employment numbers as a reason to continue raising rates, despite countless other data points signaling a severe economic slowdown is on its way. Now, for those of you who are watching, let's take a look at this chart of the Phillips Curve, and I'll try to explain it as best I can for those who are just listening. So if you imagine the Phillips Curve as a X and Y axis, with the Y axis being the inflation rate and the X axis to the right on the bottom being the unemployment rate, the model suggests that when inflation is high, so the Y axis going up, high inflation rate, call it 8%, kind of like what we have right now, unemployment rate is expected to be low, call it 3-4%, which is also where we have it right now. But if unemployment were to increase to, call it 7-8%, the expectation is that inflation would decrease, maybe back to a normalized 2-3% or even lower. And this is for the reasons that I already mentioned, like less money and overall demand due to fewer employed people to spend and drive demand. But there are instances where stagflation, unemployment high, inflation also high, coexist. And the Phillips Curve doesn't really have any way to address that. And that's not to say that we are headed for stagflation. But it's important to keep this in mind when you see central banks, or the Fed more specifically, looking to strong employment numbers as a reason to keep hiking rates. Because they think if the job market is strong, there's no reason that inflation will go down. And this is significant because it could motivate them to ignore other economic indicators or data, reports, whatever it may be, that are indicating something to the contrary, like inflation is going to go down despite employment remaining high or unemployment remaining low. All right, that does it for this 101. But as always, stay happy, humble, and most importantly, solvent.